Hi, welcome. Thanks for attending. So today's webinar, we're going to cover first-time homebuyer class, learn what mistakes that you need to avoid that could cost you thousands during the home buying process. I'm so glad that you're here, and I look forward to answering any questions that you might have. If I don't cover something in the presentation, there will be information of how to set an appointment to get in touch with me along the way. I'm happy to answer any questions you may have. And there is no obligation. I just want to make sure that people are educated, they have all the information, and they're completely empowered to be able to making a firm decision when it comes to buying a house. So I look forward to helping you, and thanks again for attending. Okay, let's get into the presentation. So I'm your guide and here to help you through your home buying process. So a little information about me. I've been in the real estate industry for over 25 years. I've helped to negotiate over 10,000 home sales as a realtor and asset manager. I've financed thousands of homes in my financing career. So I've helped many buyers navigate the pitfalls and the process of buying a house. I do pride myself on helping buyers to go from feeling overwhelmed, scared, and confused to getting their keys to their new home. So I'm putting this class together because I truly want to educate people and really help to empower them. There's a lot of terms that are thrown around during the buying process that are very intimidating and scary. So hopefully I can educate you and kind of demystify the mortgage process through this webinar. So, as a first-time homebuyer, are you stressed over the process, intimidated by it, anxious or uncertain? Don't worry, you're not alone. Myself, my team, we're all experts and here to guide you and navigate you through the process and through that uncertainty. So let's talk about first-time homebuyers. What is a first-time homebuyer? A first-time homebuyer is a buyer that has no prior ownership or they have not owned their primary residence in the past 3 years. So, and the property that you're looking at buying needs to be purchased and intended as your primary residence. So let's talk about the key steps to home ownership success. How do you go about buying a house? First, you get a fast track approval or a pre-approval with my team. We'll cover what a fast track approval is shortly. So here's the link to set up an appointment to meet with me. You will find a realtor in your area. If you don't know a good realtor, somebody that specializes in first-time home buyers, I can help introduce you to somebody. So you will sign a buyer agency agreement. In 2024, the real estate laws changed, and now you will be required to sign a buyer agency agreement prior to looking at any properties. This is a disclosure where the agents will tell you how much money that they are going to make. Some cases you may be responsible for it, or the seller may pay. And then you will go out house hunting with your realtor. You will put an offer in on a property, you'll negotiate back and forth, and then you'll execute the final offer. Depending on the state you're in, you may have an attorney review period. You will do a home inspection where you can do a home inspection, radon inspection, HVAC, sewer, whatever inspections are done, you will have a preset period within your contract. Then the lender will go through the loan process. We will issue a loan commitment. And once we issue a loan commitment, then you are cleared to close. You will have a final walkthrough and then you will sign at the title company and you get the keys at that point and move in and have your housewarming party. Pretty simple. It's not a complicated or hard process. There's just steps throughout it. So let's talk about a couple of the mistakes that you make when it comes to buying a house. Number one, continuing to rent because it's less money up front. Let me explain how. So if you continue to rent versus buy, it can be up to a $330,000 difference for you in the long run. Home ownership enables you to build wealth. A Federal Reserve study from 2025 shows that the average homeowner has 43 times the wealth than that of a renter. So you're looking at, for a renter, you have about $10,000 in assets. For a homeowner, $430,000 difference. That's huge. So how do you get that much equity, or how much wealth with owning a home? A lot of it is the equity in the home, because every single month as you're making payments, you're paying down the principal, getting more equity, and the home is appreciating over time. So the home is gaining value every single month. Plus, you have the tax write-offs and the tax benefits when you own that you don't have as a renter. So when we look at building wealth through real estate, we know it is an asset diversification method because it's a tangible asset that you have. It protects against inflation because interest rates are fixed, provides stable housing costs, gives you generational wealth where you have a tangible asset that you can pass down to your heirs. And it is forced savings because every single month as you're making your payments, you're paying down your principal and forcing you to save that money. So, oops, sorry. How much is rent costing you? Let's say you're renting at $2,800 a month. After 3 years, you're at $100,800. 5 years, $168,000. 10 years, $336,000 that your landlord thanks you because you paid down their house. Gives you no equity, no appreciation, and no tax benefits. Let's look at what that same $2,800 could buy you. If you break it down, principal and interest at $1,930, property taxes at $600, homeowners insurance at $160, mortgage insurance at $110, that puts your payment at $2,800. So we're looking at the same number. With a 6% interest rate, you're looking at about a $320,000 house. So looking at it and saying, could I buy or should I stay renting? So let's look at the long-term difference of what the appreciation of being in a property for the same term can get you. So if you're at a modest 3% annual appreciation, after 10 years, that $430,000 has, for your home value, has gained about $110,000 in appreciation alone. Well, rent has cost you the $336,000. You would just walk away from that. Home ownership, you were able to build $52,000 in appreciation. And then you're looking at your total gain with the house appreciating plus your principal payments. You're at $162,000 of tax-free money that you were able to acquire just from owning a home. A mortgage truly is an investment in your future, but only when the numbers make sense. If you are so incredibly stressed or strapped, or you're worried that home ownership isn't for you, it may not be. I'm not telling everybody you have to own a home. If you choose to, it is one of the best ways to gain wealth in the United States. So the key is knowing your full payment. Know your principal, your interest, your taxes, and insurance and mortgage insurance. Just know that your taxes and insurance can fluctuate over time. So be prepared. And when you put an offer in on a property, don't feel like you have to go to the absolute top limit of your approval, because if taxes or insurance were to change, it could make a huge difference to you. If, let's say, taxes go up $100 a month or your insurance goes up, are you able to make those payments? So mistake number 2, not knowing all of your financing options. It's confusing. There's a ton of lenders. There's a ton of programs. let's talk about the difference. Not all lenders are created equal. Mortgage bankers provide access to the most products and programs. We have a wide diversity of programs to choose from. Large banks may not have all the loan programs. So they may not necessarily offer FHA, VA, down payment assistance, or non-qualified mortgage. So you want to go to a mortgage banker, somebody like me, that is going to have access to all of the programs. Banks and credit unions, their core business is growing their deposits. And large banks typically have stricter guidelines. They want to stay in their unique lending box. A large bank, you're just one of 1,000 clients that they have. You're just a number. So you want to know exactly that you have somebody that's going to answer your calls, nights, weekends, and that's there for you. So that way you're not stressing when you have a question or need something answered. So let's talk about different types of mortgages. So you have a conventional loan and a conventional renovation loan. A lot of people, when they think of renovation loans, they just think of a 203K, but there is a conventional version. FHA and FHA 203K or renovation. And for our veterans, there is a VA renovation loan. You can get up to $75,000 to help with cosmetic updates for the home that you're buying. And the way that renovation loans work is you have your loan for the purchase plus the rehab that's getting done to the house. USDA does not have a renovation option, but USDA is available. And then you have creative loans that are called non-QM or non-qualified mortgage. These type of loans are for investors, self-employed, bank statement loans, 1099. So there's a variety of different products that are available if you don't fit in the traditional lending box. And we will sit down and discuss which option that you're qualified for once we do a loan analysis. So it's key to know which kind of mortgage is best for you, because in some cases you may qualify for VA, FHA, conventional, and USDA. So you want to know the numbers and empower yourself to be able to go out with your strongest approval when making an offer and looking at homes. So let's look at what is behind every mortgage. So myself as the mortgage lender, our job is to take the loan application, help to get you qualified, get you into that loan, and get you funded. In the back side of it, there are companies that are backing these loans and providing the liquidity to help money stay moving in the market. You have Fannie Mae, Freddie Mac, and then you have HUD and USDA. So these companies, depending on who's backing the loan, will reimburse the lender to keep money flowing so we can lend on more loans. Because as a mortgage banker, we're lending from a line of credit. If we never had reinvestment coming from any of the backing, then eventually our line would run out. So let's talk about your down payment and how much money you actually need to buy a home. With a conventional loan and a community lending product, that's as little as 3% down. You can go to 5% down for conventional. No, you don't need 20%. That's a misconception, and a lot of people are under the impression for conventional you need 20%. It's not true. For a conventional renovation, you can do 3 to 5%. And FHA is 3.5%. Same with FHA renovation. USDA and VA are 0%, and a non-qualified mortgage, depending on which one you pick, there are options where you can do 10% down. If you're an investor and looking for a DSCR loan, the minimum is 20%. So now let's take a dive into an FHA loan. That loan is insured by the federal government. It's designed to help more people, especially first-time home buyers, to get into a house. It's ideal because it's a low down payment. You have more flexible credit requirements. You have lower closing costs, and you can go to a higher debt to income ratio. And it is for primary residences only. You can get a 1 to 4 unit property. So the borrower has to meet the credit requirements for an FHA loan, and importantly, the property needs to meet the FHA requirements. So you want to make sure there's no chipping, peeling paint, no exposed wires, missing handrails, no trip hazards, and the house needs to be in overall safe condition. It doesn't have to be updated, but it does need to be safe. So again, the benefits of an FHA loan, credit score, they do enable you to go down to a credit score of 500 with 10% down. And it's easy to refinance with a streamlined loan. If you ever want to refinance in the future, you do bring money to closing with a streamline, but it is a great option if you don't want to produce any sort of paperwork to refinance. They do tend to have lower mortgage rates than conventional loans, where the mortgage insurance for an FHA loan is a little bit higher, conventional would be a little bit lower. They do go up to a higher debt to income ratio. Your total debt to income ratio for an FHA loan is 56.99%. And you can choose between a 15 or 30-year fixed loan or adjustable rates. Down payment assistance and programs are accepted, and the seller can help contribute up to 6% to help with your closing costs. Now, one benefit of an FHA loan is house hacking. That is where you're living in one unit, you're renting out the other units that you're not in. It helps you to build wealth faster because you're using the rent that you're collecting from the building to offset the debt of the property. You're able to live for less and save more money. You will need a few months of down payment, or I'm sorry, a few months of monthly payments as in reserves if you do a 3 or 4 unit. However, over the long-term loan, it is a great option because you are able to live for less because your tenants are working to pay off your property. And one thing that I definitely recommend is if you're in that situation, applying any extra money that you have towards your principal to pay the property off faster. So let's look how much money is needed for closing. We're assuming an FHA loan here. If the purchase price is $350,000, your down payment at 3.5% is $12,250. Let's say your closing costs are at $20,000. So total all in, you're at $32,000. Before you say, oh my gosh, forget it, I'm out. Let's look at what's available. If you get down payment assistance, Illinois has a program for first-time home buyers where you could get up to $15,000 to help you. So take that $15,000 off. Let's say you get a seller credit of 4%. That's another $14,000. Now you have a total credit of $29,000. Your actual cash to close is $35.50. A lot more reasonable. And what we're doing is we're using the down payment to assistance to cover your down payment. We're using the seller credit to offset your closing costs. So that helps to get you into a home for much less money out of pocket, and it helps to get a lot of first-time home buyers into homes. So let's look at down payment assistance. The interest rate in Illinois here is set by the program. Same with Indiana. Illinois has 4 different programs that are available. They may have discount points that you have to pay depending on the program. They do have credit score requirements of 640 or higher. If your credit score is over 680, you can go to a 50% debt ratio. There are income limits depending on the program that you pick. Depending on the one that you have, it either needs to get paid back monthly one program, it does have where it's forgiven, and the others need to get paid back when you refinance, sell, pay it off, or move out. And keep in mind, they do have housing price limits. So once you're qualified, we will go over what that house price is worth. Now, the downside to down payment assistance is you move in with what's called negative equity. So when you do an appraisal on a property, let's say you're buying a $300,000 home and you have $15,000 in down payment assistance. You have one loan for the 300, you have the second loan for down payment assistance at 15. So just know that that second loan is always there. That does need to get paid back at some point. So when you sell, you want to take into consideration that that second loan is there. So over time, your property will appreciate as you're in the property. In Illinois, typically it takes about, it's appreciating around 3% as a rough number per year. So once you're in the property, if you, let's say you're at a $300,000 property, in 1 year, you've gained about $9,000 in, or I'm sorry, $3,000 in appreciation. No, I had that right first. Sorry, 9%. If you're at 3% appreciation and it's $300,000 house, you've gained about $9,000 in appreciation of added equity. So if you look at the down payment assistance that needs to get paid back, typically your home has appreciated enough in about a year and a quarter to cover what that down payment assistance is. Let's look at grants. What are grants? Grants are financial assistance that's provided by a local government for home buyers. They're often targeted to first-time home buyers or specific areas or communities. The grants can cover down payments, closing costs, or home repairs. Just keep in mind that the grant that you're going for may not cover real estate fees. So keep an eye on that. Eligibility can depend on income, location, employment, or other factors. Grants typically do not need to get paid back. However, they likely do have a minimum time period that you need to live in the home. So let's look at mortgage insurance versus property insurance. Mortgage insurance is there to protect the lender in the event of default, where property insurance is there to cover the property itself should something happen. Now, let's compare the difference between FHA and conventional in a side-by-side comparison. So FHA 3.5% down, conventional 3 to 5. Minimum credit score requirement for FHA is 580. Freddie Mac for conventional is 620. Fannie Mae has gotten rid of their credit score requirement, and they're more looking at your full financial picture. Maximum total debt to income ratio for FHA is 56.99, where conventional is 50. Loan limit for a single family home with FHA is $541,287. Depending on the number of units, goes all the way up to $1,041,000. With a conventional for a single family home, you're looking at $832,750, where a 4-unit you can go up to $1.6 million. The maximum seller credit for FHA is 6%. Conventional is 3% with a 95% LTV. If you have more money down, then the seller credit can increase. So with the closing costs, now let's look at that. Where can closing costs come from? From your 401k or retirement account? Yes. From selling a personal property like a car, livestock, motorcycle, jewelry. Yes, as long as you have a sales receipt and we can verify the value. Gift from immediate family. Yes. Savings, stocks, bonds, money in the bank. Yes. Credit cards. No. So the cash advances or cash loans on your credit card? No. Can you get a loan to get a loan? Yes, only if it's secured by collaterals. Let's say if you had a car that was paid off, but you needed an extra $10,000 and your debt ratio qualified and you could get a loan on your car, then you can use that 10,000. Cash in your drawer. Depends on the amount. You can deposit some cash into your bank, but it's going to depend on how much money you make. So ask me before depositing it or before thinking of that strategy. Now, it's very important. Let's say you don't have a bank account and you're taking your paycheck and you're putting it in your friend's account who's not on the loan with you. You cannot just go and use that money from your friend's account. You want to make sure that you're establishing your own bank account. Now, first-time homebuyers, I absolutely love working with first-time homebuyers because I've bought and sold many homes myself. I've financed many homes and helped buyers navigate through the process. So I really work hard to ensure that buyers feel comfortable throughout the process and really have all of their questions answered. So, it takes a full team to get you a home loan. Throughout the process, you will have your main point of contact, which is the loan officer like me. I have a loan partner. Her name is Rachel. Rachel will help to answer questions. She's also a licensed loan officer and will able to provide numbers if need be. She's able to run credit and get answers, but I am generally always the point of contact for clients when I'm helping them do a loan. Throughout the process, though, there are many, many people that work on the loan. There's a disclosure team, there's processors, there's underwriters, there's the lock desk, quality control, closing, post-closing, and funding. But the key thing is don't get overwhelmed by the fact that there's a lot of people. Just know that at any point there can be questions and people can ask for documents along the way. And just because one person didn't ask for them doesn't mean that the next person isn't going to ask. It's still a document that's needed. So let's look at mistake number 3, not getting pre-approved. So people avoid getting pre-approved and they avoid getting their application done because they're afraid that the hard inquiry will hurt their credit score. When in fact, a hard inquiry from a mortgage banker is about 3 to 5 points. Once you make your normal monthly payments, you're going to see that rebound and go back up the next month. The large impact on your credit comes when you have multiple different industries that pull your credit. For, let's say, a car, a credit card, a boat, a RV, and then a house. If you're doing it all right in a row, then you're going to see an impact. And during the process, if you want to get pre-approved, but you're not sure where your credit is, with my team, you either get an approval or a plan. We are going to work to get your score to where it is, where you need it to be, depending on the product and program that you're looking for. So we do offer no-cost credit improvement plans when needed. And it's not a magic, a magic trick. We're going to lay out a plan exactly how long it will take to get you there. So credit reporting is changing. So just in case you've heard on the news, there is a FICO 10T that is coming out that lenders are going to start using. The benefit with that is now on-time rent payments are making a bigger impact in the approval process through the automated underwriting system. With Experian Boost, you can get utility payments added to your credit report. You'll get trending credit data that is showing a faster trend, and it's going to help more buyers qualify. Now, the downside is with this new credit scoring model, If you have any delayed financing like Klarna or buy now, pay later type of financing, those items are going to be added to your credit report. It's great because it will help add extra trade lines. It's bad because it's going to affect your DTI. And if you miss any payments, it will be a direct reflect onto your credit. So just know things are changing and it is for the better. Fix the bad habits because bad habits can hurt you. And these changes will be rolling out gradually. It won't be directly overnight, but it does help to know that, these changes that we're making, it will help more buyers to get into properties. So as a lender, we still look at the big picture. We're going to look at your payment history. So remember, when we're looking at credit score, 35% of your score is based on your payment history. 30% is utilization. 15% is length of time that you had that credit open. 10% is diversification of credit, and only 10% is your credit inquiries. So if you're paying rent and you would like, let's say you have limited trade lines, you have limited credit, you want to add your rental payments to your credit report, it can be done. These are a few companies that do it, and you can sign up with them and it will have it report. Now, some of them do report up to 24 months back, which is great. This will help to raise credit. So let's look at what our credit score. So you can actually start with a 0 credit score. I recently did a loan application for a gentleman who was born in 1947. And when I pulled his credit, he had 0 credit because he has never owned a credit card. He has never purchased and financed a car. He paid cash for everything his whole life. So in that case, opening a credit card, using it for a few months, he's going to have a credit score in the 700s. So when applying for a home loan, a mortgage lender like myself, we use what's called a tri-merged credit report, which means that we're looking at all 3 credit reports, and we're going to throw out the high score, we're going to throw out the low score, and we're going to use the middle score. When applying for a mortgage, we're using a FICO score. It may be one of the versions of FICO, but it will be FICO. When you're applying for a car or a credit card, you're going to see a Vantage score. When you open Credit Karma or your bank's credit reporting, or like for your credit cards, chances are you're seeing the Vantage score. No, the scores are not the same. When I pull it, it doesn't mean the number I have is wrong. It's just a different model. So think of you like Credit Karma. If we use a baseball analogy, it's in the ballpark, but it's not down on the field. So when we look at how credit is calculated, I briefly went over this. 35% is your on-time payment history. And 30% is the amount that you owe on that card or your utilization. 15% is how long you've had that credit open. 10% is your inquiries. And 10% is the mix of the type of credit that you have. So when we do a loan consultation, don't be afraid of it. It is actually a very easy process. When we meet, it's going to determine how much you can afford, how much can you spend on a home, and we're basing it on 3 factors. Your credit, we're using your income. So if you are working overtime, or you're self-employed, or you have commission, we're going to take a 2-year average, or tips. We're going to take a 2-year average of what is on your taxes. If you're hourly, we're going to use your hourly income. If you're working full-time, we're going to use it based on full-time hours. If it fluctuates, we're going to use a 2-year average. We're also going to look at your assets. Are you going to qualify for, let's say, a $600,000 property? you may qualify for it, but you don't have the 25,000 that's needed for closing. So we're going to look at how much you actually need to come to closing to be able to issue you an approval, so we know that you have the money needed for closing. We're going to make sure that you review the numbers before buying a house, because it's going to determine the price point of the house that you qualify for. Having an approval and having what's called a fast track approval, which I'll go over, will increase your bargaining power, because you're going in and negotiating with the right loan type and the right loan approval. And you're going to have an idea of what your monthly payment will be, plus your cash to close, and what loan product or program that you fit in. So let's talk about different types of loan approvals. A pre-qualification is good, a pre-approval is better, and a fast track approval is best. So what's the difference between these? So a pre-qualification is a verbal approval, or generally more of an estimation. So your credit can be run or it can be verbally provided for calculations. Automated underwriting is not necessarily run. Buyer verbally provides all of the information as far as income, how much you have for a down payment. This is the lowest form of qualification. Most times an agent is not going to take you on a showing with this. They are not going to write an offer. Now, what most agents will require is what's called a pre-approval. A pre-approval is an automated underwriting is run. The loan officer has reviewed your income, your pay stubs, and your documentation. The credit is reviewed by the loan officer. Down payment is sourced and documented. Now, let's say you know that you're going to save up for the next couple of months and be able to buy in the future, because you're going to have that money saved up. We can put together the plan that you're saving the money, so you don't necessarily have to have it all right then and there. So most buyers use this type of approval when submitting an offer. Now, a fast track approval. This is your strongest type of approval. This means that the file was examined by an underwriter. The underwriter issues a mortgage commitment subject to appraisal and title. They have reviewed your income, they've reviewed your credit, and your assets, so there's money in the bank. There is a promise to lend on behalf of the lender to you. This is a faster close because we only need final conditions, title, and appraisal. Instead of 30 days, we're looking at 2-week closing. So this, again, is your strongest type of approval. I do not charge for fast track approvals. Some companies do, we do not. So this gives your seller the confidence to accept your offer, and you'll be able to close faster. Now, what's an underwriter? An underwriter, and knowing who they are and what they're looking at, is key. So an underwriter is a licensed professional that reviews your loan application and supporting documents. Their job is to assess risk. So they want to make sure that they're determining if the loan meets the lender guidelines and that you actually qualify for that type of loan. So they're looking at a few things. They're looking at capacity. Are you able to repay that loan? Do you have the income that's supported? Do you have the employment history and stability of employment? Do you have savings? Are your monthly debts in line? Do you have other financial obligations? They're looking at your capital. How much money do you actually have? And do you have any sort of investments? How much equity is going into the property? And they're going to look at the value of the asset itself or the property. They're going to look at your character, your credit history. Do you have on-time payments? Do you have bankruptcies? Do you have the stability? Are you a recent graduate? If you are, then we can use your education and schooling as history to show character. You have earning potential, and you're going to live in the property, or you're going to be stable when it comes to housing. So for the home, they're going to look at the collateral or the property that you're buying. They're going to look at the value, the condition, the property type. They're going to look at the title. They're also going to look at the location, because depending on the type of loan that you have, location matters. FHA, you cannot necessarily be next to a gas station with above ground fuel tanks. So it's going to depend on the type of loan that you're getting. So, do's and don'ts while you're shopping for a house. Schedule a loan consultation first and foremost. Don't be afraid of it. Know that it's going to empower you to be able to buy a property. Schedule a loan consultation. Call us if you have any questions. Continue living at your current residence. Don't move during the process, because if you're already paying rent and that rent is helping to get you qualified, if you stop paying rent, it's going to change your loan approval. Continue paying on your mortgage or rent, even though if you're going to close, let's say on the 15th of that month, but your rent is due on the 1st, make sure that you pay it. Same with your mortgage. Delays can happen, and then you can forget to make that payment. Continue using credit as normal. Don't fear that, oh my gosh, I have to stop using any type of credit. That's not the case. Continue using credit as normal. Keep working at your current employer. If you need to change jobs, you can do that, but let's have a conversation first. If you get let go, let me know, because we will find out. Keep working with the same insurance company. If during the process, I'll have you get a quote for your homeowner's insurance. If you tell me I'm going with State Farm and then you change and go to Allstate, we may bind it with the wrong company. So pick one and stick with it. Stay current on all your existing accounts. Don't let your car payment go late. Don't let your credit cards go late. Make sure you're staying consistent. Expect requests for additional documents along the way, and don't feel like we're asking for it again. If you've already sent it, explain, I've already sent this. Are you looking for something different? Because chances are we might be asking for something different. So these are the don'ts. Do not make any large purchases. Don't go and open any credit for any furniture or carpet or anything like that. Don't change bank accounts or make any large cash deposits. Do not transfer balances, and don't close any credit card accounts. Do not consolidate all your debt onto one or two credit cards. Do not apply for new credit or take out a loan or co-sign on anyone's loans. Do not change or quit your job without a conversation. Do not max out or overcharge on your cards. Use them as normal. Do not pay collections without talking to your loan officer. Now, here's another big mistake: not working with a buyer's agent. You want to work with a buyer's real estate agent. A buyer's agent is your advocate. They are going to give you expert advice. They are a strong negotiator. I apologize. They negotiate deals every single day. It's an emotional decision for you to buy a house. A real estate agent is going to negotiate the best terms on your behalf for you. They will help to facilitate going through the contract, the paperwork, and you want their expertise in negotiating the terms of those contracts. They're going to give you access to more homes. They're going to save your time and stress, and they're going to ensure it's a smoother experience by using an agent. In 2024, the National Association of Realtors did have a settlement where they wanted to improve transparency of how much real estate agents were making during the process. So now there is a buyer agency agreement that you will be asked to review, that will cover how much money it is the real estate agent making or what percentage. Now, understand that agreement, that you are signing that and you are agreeing to it. So review the commission obligations with your lender. In the event that you have to pay and are obligated, we need to know exactly how much you've agreed, because we want to make sure that it's included in with the loan numbers as cash that you will be bringing to closing, so you're not surprised when it comes to closing of how much you're bringing. Know that the contract that you're signing with the agent is flexible. You can negotiate the length of it. You can negotiate how much the commission is, the duration. So just understand and read what you're writing and know that it is a legally binding contract. So mistake number 5, skipping a home inspection. So many times I've had clients that have waived a home inspection because they're in a multiple offer situation or they don't want to spend the money. That $500,000 to $750,000 could cost you $20,000 to $50,000 in inspections. I recently had a client that bought a home and she did not want to do an HVAC inspection. The HVAC inspection would have cost her an additional $2,500. She bought in Florida. And then after closing, she goes into the home, turns on the air conditioner, finds out it doesn't work. Well, they have a UV light system in the furnaces in Florida because they have a lot of mold there because the air conditioners run all the time. The UV system was not working. The air ducts were filled with mold, and the air conditioner compressors needed to get replaced. She's now looking at $38,000 worth of work that needs to get remedied for her brand new home that she just bought. So if you skip a home inspection, you could be unaware of risks that you're inheriting, like non-structural safety issues, mold, radon, carbon monoxide, and you miss having a forecast of future repairs that could be needed and maintenance items. You lose your negotiating power. When you buy a house without an inspection, it's yours. You get it the way it is. And you lose the chance to establish a list of items that you could change your loan and decide, okay, I'm buying this house, but it does need work and I'm okay with it and I want to move forward, but let me flip to a renovation loan. So you're losing that ability. With a property, if it's found to have anything health and safety, then you have the ability to negotiate with your seller and ask them to correct health and safety items. So things like radon. So keep in mind that you want to make sure that you are buying a property and you are going in eyes wide open of what you're buying. So let's recap what we discussed today. So know your financing options, get pre-approved before going on a home showing. Don't just go to the bank for your mortgage. Explore your options because there's a lot of different programs out there and not all lenders are created equal. Not having an agent represent you is a huge deal. Make sure you have somebody that's an advocate on your side, even when you're buying new construction. Don't skip a home inspection. The biggest mistake we've seen financially is continuing to rent versus buying. And I'm confident using these tips will help give you a significant advantage when buying a home. Hopefully you feel confident in being able to purchase a home now. Should you have any further questions, please reach out. For attending, you will receive a $250 lender credit at closing when you close with me. So I look forward to helping you. Reach out if there's anything I can help with. And thanks again for attending this webinar. Happy home shopping and congratulations.